Let's speak about Disney stock, baby. What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're taking a look at Disney, in particular the magic of the magic of Bob Iger. Is it Iger? Is it Iger? I'm actually not even sure. But anyway, Big Bob we'll call him today. So Big Bob is the previous CEO of Disney. He served for many years. He left with plans of retiring, and we got a new CEO in, and now he is coming back. He must have decided he doesn't want to retire anymore. And with Disney being sub $100 and having hit recent lows of sub $90, we're going to ask the question, is it time to add to our long-term positions or potentially even open up a position for the first time ever? Another stock down 50% from all-time highs. And in order to do that, what we're going to do is we'll have a look at Bob and the company's previous history under him. We'll take a look at some of Disney's financials, and we'll take a look at the two biggest problems ahead of Disney and how they need to be solved in order for Disney to get back to, previous all-time highs, previous booms. Right before we do that, my friends, I'd just like to thank everybody who's come back to the channel for the support on the last couple of videos. I appreciate you all, and I'm glad to be back. Also, if you want to see more videos, all you got to do is hit that juicy like button and subscribe if you're new around here for more content. And also, drop me a comment. Let me know how you feel about Disney, baby. With that being said, let's get into the video. So Walt Disney Company has decided to bring back Big Bob, the company's prior CEO. This move brings back perhaps the most successful CEO the company has ever had, and is a rallying cry for those seeking change in the business. And again, guys, people are seeking change in the business, considering, again, it's down more than 50% from all-time highs, which was not too long ago whatsoever. Although some changes should be made, investors shouldn't expect a lot, and that's fine. And I think this is something that's going to be important. Disney popped off of this news straight away, many percentage points, but Disney's still going to be facing the same challenges that it has in front of them as it stands today. On November 21st, shares of Disney soared higher in response to the news that he would be coming back to the CEO position and replacing the current CEO, Bob chpt. This was a sudden development and comes only around 2 years after Iger left the enterprise. Previously, he had served as CEO from 2005, so again, guys, very long-term serving CEO, until February of 2020, when he stepped down with the idea of retirement in mind. Now, again, keep in mind, this was the very start of Ronnie time, so maybe he just didn't want to be involved in that, and he's coming back now that things have calmed down, or it genuinely was retirement. But he was also still on the company board as an executive until 2021. In response to volatile conditions at the company, Iger was lured back to the Walt Disney Company with the hopes that he could instill confidence in investors and generate significant value to get the company back on track. Now, I have to say right off the bat, he definitely did install some confidence into investors. You can see it from this move here, from $90 a share all the way back up to $100 in the span of a day, and keeping an awful lot of that value as well. So there's definitely a lot of Disney investors who are happy to see him back. And I mean, if we just take a bit of a scroll out to even our weekly charts on Disney, you can see that his time as CEO, they would have gone from around $20 a share all the way up to $200. So very good performance from him all in all. And then the ultimate expectation from investors is that the glory days of the company can come back. Now, I think that's what obviously everybody would hope for. That's what everybody wants. You want your CEO to carry your company to greatness. Now, I think one thing to understand and one important question to ask is this one here. How bad was chpt? So, the CEO that we got just after Iger. In 2019, for instance, the company generated adjusted operating cash flow of $11.63 billion, although this figure declined to $8.26 billion in 2020. The regular operating cash flow of the company did manage to rise from $5.98 billion in 2019 to $7.62 billion the next year. But then, in 2021, cash flow plunged to $5.57 billion, with the adjusted figure $3.37 billion. And at the end of the day, cash flow is what determines the value of an enterprise. I mean, this is where pretty much all valuation metrics come into play. To see the picture worsen in such a manner was discouraging, but we have to keep in mind that much of this was likely outside of the company's control. It was Ronnie times, my friends. Most large companies' balance sheets would have got hit. Their operating cash flow, their free cash flow would have got hit, especially ones such as Disney, who make so much of their money from the tourism industries, from their Disney theme parks. And to be fair to Chadwick, he did take action, he did take initiative with the likes of Disney Plus. And net debt for the company during the final quarter of his reign was $41.24 billion. This dropped to $36.75 billion as of the latest quarter, which is quite impressive for a company dealing with a global pandemic and investing significantly in its streaming operations. Now, this streaming operation, guys, are actually one of the two biggest problems that will have to be solved. And again, that comes down to cash flow reasons and it not being profitable just yet. But to be fair, under his watch, the Walt Disney Company became the largest streaming company on the planet, with Disney Plus expanding to 164.2 million subscribers, ESPN Plus to 24.3 million, and Hulu hitting an all-time high. Hulu's been around for a while now, of 47.2 million. So, I mean, you have to give a round of applause there. And when it comes to Disney Plus as a whole, the expectation for it is to grow to as large as 245 million subscribers in 2024. Now, this is important because we're going to elaborate on this in regards to, you know, what Big Bob is going to have to do going forwards. So that's a little bit of background. That's what, you know, the previous CEO has done. Now, what is Big Bob going to have to come in and fix to get Disney back up to, you know, all-time highs, or realistically just get back up above $100 and stay there for any meaningful reason of time? So the first problem is Disney Plus burns more and more money, and this isn't a problem that can be ignored. Obviously, you know, if you treat Disney Plus, specifically the newest Disney Plus streaming platform, as a startup almost, you expect there to be some cash burn there. It doesn't necessarily need to be profitable quickly, but it does need to be profitable at some stage. So since the parks were closed during the pandemic, Bob Chapek during his tenure focused mainly on developing the Disney Plus streaming platform. That platform in a short time has gained a great response from the public, and it really, really has. Currently, it's the third largest streaming platform by subscriptions, just behind Amazon Prime and Netflix. Certainly a great result, but there is one problem. Disney Plus is unprofitable, and the company does not seem too concerned. Overall, in fiscal year 2020 through 2022, Disney Plus revenues were 2.8 billion, 5.2 billion, and 7.4 billion respectively. So obviously considerable revenues for any company. And you can see that the revenue growth there, again, is absolutely fantastic. I don't think anybody would be able to argue that. There's not an argument to be made there. But the problem is that despite such smart growth, Disney Plus continues to burn money because of operating costs that are growing more than revenues themselves. The result is that Disney's revenue increases, but operating income decreases. And if you just start to take a look at the balance sheet, the cash flow, even the income statement, you're going to see this. If you look at Disney, you'll see that they've done a great job to get those total revenues up. But if you look at the cost of revenue, how fast they have gone up, especially in 2022 so far, it's leaving their GP considerably, and I mean considerably lower than previous years, which is a big concern and is a reason that would warrant a company coming down in value a considerable amount, at least in the short term. If you look at the balance sheet, you can see total assets are pretty much sticking somewhere around where they were. They're looking pretty good all in all. That's just the way it is, which is very good to see. Now, if you look at the balance sheet, you can see total assets versus total liabilities are quite good. And as we said, net debt has come down. So, I mean, that obviously is a quite positive thing. But again, if you look at the cash flow, you can see that end cash position coming down considerably the last couple of years. And you can see free cash flow again coming down. So, you know, it's not all sunshine and rainbows here. Some big changes will have to be made. And Disney Plus is probably one place that it really is going to have to be focused on getting those increased revenues. The other one is obviously the theme parks, which is the second big problem that we're going to be speaking about shortly. The direct-to-consumer segment experienced a larger operating loss in fiscal year 2022 than 2021, despite revenues increasing by 20%. And I mean, look, there has to be a balance somewhere found for Disney, in my opinion, for them to turn back to this kind of stock chart, the steady growth. And again, guys, a lot of this does just come down to Roni times, whatever. But, you know, this steady growth comes with steady company growth and steady revenue growth, and not, you know, nice revenue growth, but huge, you know, cost of revenue. And the worrying impression is that the more Disney Plus grows, the more Disney loses money. And that is obviously not what, you know, any company wants. And it's difficult to understand, you know, how are they going to keep this growth happening but reduce the operating loss here? Because that really is the big question, because you have to think if they just decide to charge an extra $10 a month to every single one of their customers, well, they're probably going to lose half their customers, quite literally half their customers in this economy especially. So it's not necessarily an easy problem to fix, but I suppose maybe that's why Big Bob's coming in to try and fix that problem somewhere, somehow. And then the second problem is this: Disney parks being too expensive, my friends, okay? So Q4 2022 results, we can see there was a clear improvement over Q4 2021. And I mean, yeah, 36% change. Very, very juicy. That's what parks and experiences. Happy days. So if we were based on Q4 2022 results, the price increase was a good move. So there was obviously price increases for their parks. However, there's concerns about whether it's sustainable for the next few years. 2022 was a record year in terms of vacations, and the reason for this is mainly because the previous 2 years of Roni limited people's ability to travel. And I mean, this is true. I'm sure a lot of you guys watching this video maybe did take an extra holiday over the last year or so, because we weren't able to do so during Roni times. I know me, I was very, very happy to get away. And I actually ended up in Disneyland Paris. And yeah, it was definitely more expensive than the time I previously had gone there. And as a consumer, that is something you do take note of. So right now, you have to keep in mind again, maybe people hadn't spent their holiday money over the last 2 years. They were more willing to spend more money on, you know, maybe a bigger holiday than they normally would do because they had that extra bit of money saved. Now, obviously, that doesn't apply to everybody, but some people might have had these holidays paid for in advance and they had another couple of years to put some extra money aside. So from a revenue standpoint, it was a success for the parks. So from a revenue standpoint, 2022 was a success for the parks. We can clearly see that 36% growth. Beautiful. But we often tend to overlook something that's perhaps even more important. It would seem the park's higher prices have disappointed fans' expectations. 92.6% of people believe the cost of a vacation to Walt Disney World Resort is out of reach for the average American family. I mean, yeah, that's just simple facts. It's very expensive. I know I'm not an American person, but if I was to want to do that, traveling from Ireland especially, wow, I'm probably looking at 5 figures. The money is absolutely insane. 68.3% believe Disney World has lost its magic due to excessive costs. And I can even speak as somebody who went to the Paris Disneyland. You do think about it. You do think about it. If you're spending more money and then you're spending more money on food and then it's busier than the last time you're there, you feel like the service as a whole goes down and you're spending more money. It does leave you with a slightly more sour taste in your mouth than potentially when you've gone at a quieter period of time and paid less for the same service or even worse service. 66.9% of people believe they will not get the full Disney World experience unless they upgrade to Genie Plus and purchase additional admissions to Lightning Lane. So I mean, guys, these are big issues and they're common sense issues as well. When you think about Roni, you have to give companies a lot of leeway, especially ones like Disney, especially ones who, you know, the parks were always a huge source of income for the company. But how are they going to be fixed? Well, Big Bob needs to figure that out, baby. The reason I'm making this video is because I have been looking at Disney again recently. I do have a position in them. I've had it since somewhere 20 times when the big crash happened here. And you can see that, yeah, there would have been a really nice return on that. But a lot of that's come back down. And you can also see that as of right now, they're at levels from February of 2015. These recent lows here, or let's say $87, go all the way back to the last quarter of 2014. So much value has been wiped out on Disney, which for a long time was considered, you know, a value stock, a very safe stock. They paid a dividend for the longest time as well. I don't see that coming back anytime soon, and it was only ever really in the realms of 1 to 1.5% for the last 5-6 years of the dividend at the very least. So I wouldn't go in here expecting a dividend anytime soon if that is one thing you are looking towards. But anyway, my friends, that is my current thoughts on Disney and Big Bob coming in to take over and hopefully, you know, turn things around, make things a lot better for the company. Because I love Disney at the end of the day. I think everybody has a place for Disney in their hearts. I think we all grew up on Disney no matter what generation we were, really. It's something that everybody loves. And I want to see it flourish. So I will, of course, keep you guys up to date if I do, you know, keep looking into them, find any more news if I do decide to ultimately invest in them at some stage soon. But if you have watched this video all the way till the end, you, my friend, are a true legend, and I really do appreciate you from the bottom of my heart. Your support means the world to me, baby. If you did enjoy, again, please hit that like button if you haven't yet, and subscribe if you're new around here. You may as well, why not? Anyway, guys, I hope you all have a beautiful, blessed day. I'll see you in another video very soon. Peace.